This is Tal Davidson, and today I'm going to present a company which I've been holding for about 3 quarters. During this time, shares have been trading sidelines and recently declined about 20% from my original purchase price. Nevertheless, trading at under $8 a share, I believe that Rosetta Stone is still a good investment, and it is still a large position of mine. A few words about myself. I am an individual investor from Israel. I've been practicing fundamental analysis and value investing for about 10 years now. In 2014, I started the Inspiration Fund, which is a model portfolio tracking my own personal funds. If you wish to learn more about me and my approach, check out my website at taldavidson.com. This is my second investment idea webcast, and I hope you enjoy it. Two important disclaimers before we kick it off. First, I may make mistakes in the data presented or in my conclusions. You should always do your own due diligence before doing anything, nonetheless committing capital to an idea. Secondly, you should be aware that I'm not a registered investment advisor nor a portfolio manager. I am in full compliance with the law, but you should in any case be aware that you act at your own risk. With that, let's kick it off. If you're American, you may be familiar with Rosetta Stone as the company who sells language learning CD-ROMs in malls and airports. You may have crossed by their kiosk in an airport or a busy mall, or bumped into their yellow boxes in Walmart. But that was before 2012. Since then, Rosetta Stone started winding down their so-called brick-and-mortar business and started growing their language offering through web-only subscriptions in a model known as Software as a Service, or SaaS. In the 4 years since the transformation to SaaS has started, the decline in the old physical goods business was faster than the growth in SaaS. New revenue just doesn't grow fast enough to replace old revenue, which is evaporating. The company is non-profitable since 2011. Not only that, but until recently, the company was shooting in all directions, targeting the enterprise and education segment and North American consumer, and trying to ramp sales abroad, mainly in Europe, Japan, and Korea. Rosetta was ill for a long time. It was unprofitable and unfocused. The transformation is taking longer than anyone had expected, both management and shareholders. Actual business results fell short of projections made along the way, time and again. Disappointments came in every year, and the stock price has been tumbling as a result. My investment thesis is simple. Rosetta has good competitive products, good strategy, the right entrepreneurial spirit, and hopefully, it finally has the right focus. With its committed management and activist shareholders such as David Nierenberg and Osmium Partners, it will pivot and refine its game until it gets it right. Once it does, share price will go up significantly. As long as it doesn't get it right, share price will not go down much farther, as the company is already priced for disappointments. One can summarize this investment idea with the famous quote from Manish Pabrai, "Heads I win, tails I don't lose much." I first picked up Rosetta's shares in July 2014, when the price hovered between $9 a share and $10 a share. Since then, I have increased my position at about the same levels. The reasons for buying then were not much different than the reasons for recommending the stock now. Stefan Swad stepped in in February 2013 after the stock declined in price from $30 a share to $6 a share. He has assembled a management team and put forth a strategy to evolve from the old brick-and-mortar model to a new SaaS model. He made bold decisions like closing down kiosks and making 4 meaningful acquisitions, which I will discuss later. In 2014, management already identified that the Korean and Japanese markets were not profitable and made the bold decision to exit those markets. Above all, the stock price was cheap, selling at an enterprise value of less than half its bookings. And the strategy of Rosetta is simple. Transform from the old model of selling CD-ROMs in kiosks and retail doors to a fully SaaS-operated company, focused on professional segment, which they call enterprise and education segment, and on serious consumer learners. The four major acquisitions made in 2013 and 2014 were strategic in the sense that they were needed to form a well-rounded online business by complementing existing assets. Lexia is a SaaS vendor of literacy or reading skills products for schools. It helps building Rosetta's position in the enterprise and education business and now comprise about half of the enterprise and education segment, which is the main growth driver of the company. Live Mocha is an online community of language learners, which allows interactions with other learners and with teachers. With 16 million registered users, Live Mocha strengthens Rosetta's online presence and provides a gateway to offer its premium language courses to serious learners. Tell Me More is a competitor, selling language and literacy courses in SaaS format to customers. Its products complement that of Rosetta's, and it has a good international position in Europe and in China. Vivity Labs is the creator of FitBrains, brain fitness games for kids and adults. FitBrains sells nicely on mobile app stores, providing additional access which allows cross-selling to potential customers and building a presence directly with kids. In the Investor Day of February 2014, Rosetta presented a strategy which addresses all of its three reporting segments: Global Enterprise and Education, North American Consumer, and Rest of World Consumer. They were shooting on all fronts. This has caused David Nierenberg, the third largest shareholder, to turn activist, complaining about initiative overload and calling for increased focus. Let's consider some financials next. A look at the GAAP income statement looks very uninspiring. Revenue is not growing, and the company is showing a loss from operations from 2011 and on. But GAAP statements do not tell the full story. You see, the growth in SaaS revenue is not fast enough to replace the quickly declining revenue of the old kiosk model. In addition, SaaS revenue come in the form of multi-year subscriptions, in contrast to a full payment upfront in the old kiosk model. So that calls for a discussion on the concept of bookings versus revenues. Bookings is a non-GAAP measure which is used by the company in earning releases and conference calls to describe its business. To understand what bookings is, I laid out the following example. It shows how a hypothetical 3-year subscription, let's say to a $300 online English learning program, would be recorded as GAAP revenues versus how it would be recorded as non-GAAP bookings. GAAP revenue is recognized when the service is given, So even if the customer paid $300 in full when registering for the online course, the revenue will be recognized on course of the program's duration, which is $100 a year in this example. Deferred revenue is a balance sheet liability which holds the cash that was paid by the customer until the revenue can be recognized in a following reporting period. In contrast, bookings reflect revenues and changes in deferred revenues, or as laymen would call it, new business that comes at the door. So the bookings is $300 in year one. In the second example, every year a new customer buys the same $300 3-year subscription program. Bookings will show $300 every year starting year one, while revenue will rise gradually, reaching a $300 run rate only from year 3 and forward. There's an important point to make here. Changes in the amount of new business coming at the door will reflect immediately on bookings, while the GAAP revenue will lag. Some seeking alpha contributors are treating bookings as accounting shenanigans, but bookings do reflect a true economic measure of the company's business, as long as one understands what it means. Another advantage of assessing bookings is that bookings are not sensitive to changes in the duration of the subscription periods. If the online course subscription changes from 3 years to 2 years, or from 2 years to 4 years, bookings will stay the same, while GAAP revenues will spread out to the new duration of the subscription period. The company is doing a service to investors by publishing quarterly an economic income statement, which is based on non-GAAP bookings. Again, bookings reflect revenues and changes to deferred revenues, or new business coming at the door. What you can see here is that the business is growing, in part thanks to the acquisitions that were made and recognized in 2013 and 2014. Bookings have grown from $278 million in fiscal year 13 to $309 million in fiscal year 14. Adjusted EBITDA is based on bookings and actually declined from 2013 to 2014, mainly because of excess sales and marketing expenditure. Critics are saying that bookings are growing because of the large investments in sales and marketing. If the company were to reduce its marketing spend, bookings were to decline. That is probably true more in the consumer space, but less true in the enterprise and education segment. In the enterprise and education segment, the churn rate is expected to be lower. Once an organization decides on a vendor, the duration of the engagement should be longer than that of a consumer. The largest investor in the company's shares is Ariel Investments, which owns 18% of the shares, yet it is only 0.5% of their total holdings. The second largest investor is Osmium Partners, a California-based hedge fund led by John Lewis, an activist value investor. Osmium recently sold 1/10 of their position, but they still hold 9.5% of the shares, which is one of their largest positions, a 1,400 position of their total 13F portfolio. David Nierenberg of D3 Funds owns 7% of the shares. Rosetta accounts for 20% of his 13F portfolio, and it's one of his largest positions indeed. Nierenberg turned activist in 2014 and filed a 13D disclosure with the SEC. John Lewis of Osmium Partners laid out a 4-point action plan to the company in November of 2014. 1. He urges the company to improve execution and increase free cash flow margins from 2% in 2014 to 4% in 2015. 2. He calls for focusing on both consumer and education and enterprise segments. This is different from David Nierenberg, who later applauded the pivoted strategy to focus mainly on education and enterprise. 3. He calls for improved disclosure. And 4. He urges the company to buy back shares, as he believes that the balance sheet is overcapitalized. David Nierenberg filed a 13D in June 2014. In it, he applauds management for the steps it has taken, like closing the kiosk distribution channel, like withdrawing from the Japanese and Korean operations, like injecting fresh ideas by management, reducing low-calorie consumer marketing expenditure, and buying the 4 company I discussed earlier. He's saying that these 3 are very strong believers in the value of the company. And he calls for better execution of strategy. He calls for better allocation of scarce resources, such as cash and executive and board time. He calls for better board oversight and for better investor understanding of the company's potential. He says that the best proof of what a CEO with a maniacal focus can accomplish is what Steve Jobs did at Apple. He also thinks that Rosetta Stone focus is not tight enough. So after faltering and showing modest success in 2013 and 2014, Rosetta pivoted again and presented a revised strategy in March 2015. It will now focus even more on enterprise and education segment, which is comprised from its language courses and its Lexia literacy products. It will continue making investments in the products and in sales and marketing that goes into that segment. In consumer, it will pull out of most of it, cutting investments and reducing 15% of its global workforce. It will still have consumer offerings to serious learners, those who are willing to pay handsomely, and only when it complements enterprise and education. By this, Rosetta admits that it can't and doesn't want to compete with free apps and services like Duolingo. It addresses only the very high end of the market, which is not so sensitive to price. The third part of the strategy is extreme cost cutting. Rosetta acknowledges that its cost structure is too high. In 2014, operating expense was about $215 million compared to bookings of $300 million. Rosetta plans to cut $50 million annually, starting in 2015, mainly by reducing its workforce and cutting its sales and marketing expense of its non-core units. The proceeds will be used for investments in the enterprise and education products. Once again, to the dismay of its shareholders, Rosetta revised its guidance. It did not give bookings guidance, except for saying that bookings are expected to grow at an accelerated rate. It said that operating margins will reach double digit by 2017, that of enterprise and education, of course. For the consumer segment, it said that booking will decline from $196 million in 2014 to about $110 to $130 million in 2015, and that bookings will settle on $50 to $75 million in following years. It projects a 10% EBITDA margin by 2017. The company's guidance have been way off, and the company disappointed with reduced guidance quarter after quarter. Let's see how projections have changed across the previous 2 years. In May of 2013, the company projected bookings to be $280 million to $290 million and upped that number to $287 to $298 million after the purchase of Lexia in July. The company revised down bookings to $270 to $280 million. The actual figure was $278 million and $16 million in adjusted EBITDA. For 2014, the company projected above $315 million in bookings and above $18 million in adjusted EBITDA, and recently came in with the actual result of $309 million in bookings and a mere $12 million in adjusted EBITDA. The earnings announcement in March 2015 has sent the shares down 20%, from about $10 a share to below $8 a share. The largest blow, though, is the change in the long-term bookings projections. In 2013, the company believed it could reach bookings of $400 million by 2015 and a 10 to 13% adjusted EBITDA margin. That target was pushed to 2016 in February of 2014. The $400 million figure was based on the assumption that the company invests both in enterprise and education, and both in consumer, North America consumer, and global consumer. Recently, in March 2015, came the final blow. With a strategic pivot to focus on the enterprise and education segment, downsizing sales and marketing spend, and pulling out of the consumer business, the long-term target of $400 million bookings was dropped. The only one making long-term projections now, or better call it hopes, is David Nierenberg, who wished the company would turn $250 million bookings by 2017 with a 10 to 15% EBITDA margin. And this is how the company guidance, which was published in March 2015, looks like. The company projects global E&E bookings to be between $122 to $130 million and consolidated adjusted EBITDA to be between $8 million and $12 million. I absolutely love it when David Nierenberg participates in the Q&A session of the conference calls to make his statements rather than to ask questions. In the most recent one, he said the following things. We think you are absolutely right to focus on E&E and serious learners, and absolutely right to try to take in at least 50 million out of the cost structure. We urge you to zero-base the cost of the company and to think about it as if it was a private company owned by yourselves. We don't mind if Rosetta Stone is not a 400 million sales company next year, which is what you thought and hope that would be 3 years ago. We are perfectly happy if several years from now, say in 2017, it's a $250 million revenue company with 75 million in consumer, with a 10% EBITDA margin, and $175 million in E&E with a 15% EBITDA margin and a nice double-digit growth. Nierenberg is still on board this ship. He had put the past in the past. Even with the reduced outlook, the company is an attractive holding for him and for me. In March 2015, he filed another 13D disclosure saying the following. On March 11, 2015, the issuer announced that it is refocusing its strategy and realigning resources around its global enterprise and education segment in order to pursue the most attractive opportunities for enhancing shareholder value. The reporting person support, meaning David Nierenberg, the issuer's strategic initiative, and on March 13, 2015, recommended to the issuer's board of directors several changes in executive leadership, which the reporting person believed to be appropriate to execute the issuer's new strategy. He may be hinting that he would be considering a proxy fight to change management. Let's discuss valuation. Here we see a list of SaaS companies and look at their valuation. The average EV, enterprise value to sales multiple, is 6.7x. Using this metric, Rosetta is not overly expensive, selling at about half x, 0.5x EV to sales. So to assess the valuation, I laid out three scenarios. One is the hopeful scenarios laid out by David Nierenberg. So if his assumption turned true, the total adjusted EBITDA would come at $33 million at 2017. Let's assume an EV to EBITDA multiple of 16 to 20x or sales multiple, EV to sales multiple of 2 to 3.5x. And let's assume that the cash which is left on the balance sheet in 2017 is $14 million. The stock price will probably be higher than $24.5 million. This would mean a triple or more than a triple from today's price, which is $7.5 a share at the time of this recording. My base scenario is based on the low-end company projections. I assume that enterprise and education bookings will grow at a 7% annual rate and reach $140 million in 2017. I also assume that the consumer bookings will come at $50 million. So the total bookings will be $190 million. If I assume only 12% adjusted EBITDA margin for the E&E segment and 10% adjusted EBITDA margin for the consumer segment, I come up with a total adjusted EBITDA of just below $28 million. And assuming somewhat lower multiples like 12 to 14x EV to EBITDA or 1.5 to 2x EV to sales and cash of only $30 million left in 2017, I come up with more than $14 a share, maybe $16 a share, maybe $19 a share. Well, this would be a double from today's prices. In my low-end scenario, I assume that bookings for E&E stays not much higher than today, $125 million, and consumer booking still at $50 million. I also assume a lower adjusted EBITDA margin for the E&E segment, like 7%. So in this case, adjusted EBITDA will come at $13 million or nearly $14 million. And here I'm taking really low multiples, 10 to 12 EV to EBITDA or 1 to 1.5 EV to sales. And I assume that no cash is left in 2017 on the balance sheet. I didn't take cash into account at all. And my absolutely lowest valuation for the company is $6.25 a share or $8 a share if you base your valuation based on EV to sales. This is not much different than the price today, which is $7.5 a share at the time of this recording. So you see here that the upside is very high, potentially a double or a triple if the company gets its act together, but not significantly lower than what it trades today if the company continues to disappoint and falter. So to summarize this investment idea, I believe that the business model is finally viable after pivoting for several times. I believe that management gets little credibility and thus it is incentivized for success. The pressure from David Nierenberg helps incentivize management to succeed. They have an unspoken threat to be thrown away. I believe that the price is cheap. Even modest success will result in excess returns. And there's no much downside from here at $7.50 a share. Investing in Rosetta Stone requires putting the ego aside, believing that the assets are valuable, and taking a leap of faith in the management, albeit the disappointments. After all, even either management make things right or David Nierenberg will exercise his threat and kick them out. This was my second investment idea webcast ever. Check out my website, taldavidson.com, to access my real money model portfolio, stock ideas, and additional webcasts. Hey, I'm just starting out. Did I earn the privilege of receiving your feedback? Let me know how I can make my webcasts better. Give me feedback. Thank you for listening. Bye.